Picture this. You've been dreaming of an extended Italian vacation, right? Or maybe you're even thinking about taking your laptop and setting up a remote work life right from a villa in Tuscany. I mean, it sounds absolutely idyllic. But could that extended stay accidentally trigger a massive global tax bill? Well, welcome to this explainer. Today we're going to dive deep into the brand new 2024 rules surrounding Italian tax residency. Because of a major reform, specifically Legislative Decree No. 209/2023, and some recent clarifications from the Italian Revenue Agency, the rules of the game have fundamentally changed. If you plan on spending any significant amount of time in Italy, you absolutely need to know how this works. So here's our roadmap for today's explainer. First, we'll cover the tax residency basics. Then, the 4 specific ways you can actually trigger residency. Third, we'll walk through the steps to officially transfer your residency. Fourth, we'll tackle the dual residency dilemma. And finally, number 5, the real-world consequences of becoming an Italian resident. All right, let's jump right into part 1, the absolute basics of tax residency. Now, you might be wondering, why does this label even matter? Well, there is a stark night and day financial contrast between these two statuses. Tax residency is basically the main connecting factor between you and a country. If you're classified as a non-resident, Italy is only going to tax you on income that is actually produced within Italian borders. Simple enough, right? But, and this is a massive but, if you are classified as a resident, you are suddenly subject to what's known as worldwide taxation. That means you literally have to declare and pay taxes in Italy on all your income, regardless of where in the world you earned it. It's a huge deal. So the absolutely crucial thing here is understanding exactly how you cross that line. And it all comes down to this magic number, 183. If you meet the residency requirements for most of the tax period, which translates to at least 183 days in a standard year or 184 in a leap year, you become a tax resident. And here is a crazy detail about the new rules. They now count fractions of a day. So yes, every single hour you're there actually counts towards your total. Okay, moving on to section 2. Let's look at the 4 specific ways you can trigger this residency. Under the new laws, there are 4 main triggers to keep on your radar: registered residence, domicile, civil residence, and physical presence. Now pay close attention here, because meeting just a single one of these requirements for more than half the year is enough to trigger your global tax obligations to Italy. Let's break down exactly how the 2024 reform tweaked these. First up is registered residents. Basically, anyone registered with the Resident Population Registry, often called the APR, of an Italian town is presumed to be a tax resident. But we have a major 2024 update here. This registration is now what they call a rebuttable presumption. In the past, being on this list was an absolute trap. There was no way out. But now, if you're on the registry but you can prove you don't actually live there, you have the legal right to fight it and provide evidence to the contrary to avoid taxation. That's a real game changer. The second big change completely flips the concept of domicile on its head. Previously, your domicile was heavily based on where your economic or business interests were centered. But as of January 1st, 2024, domicile is officially defined as the place where your personal and family relationships develop. The authorities aren't just looking at where your business operates anymore. They're looking at where your spouse is, where your kids go to school, where your stable family life actually happens. And that brings us to physical presence, which is a totally new standalone criterion for 2024. This example perfectly illustrates the danger here. Let's say we have someone officially registered as a resident in Dubai. Their family lives abroad too. Paperwork-wise, they have 0 ties to Italy, but they decide to physically hang out in Italy for 190 days during the year, maybe remote working or just vacationing. Because those 180 days cross the 183-day threshold, boom, they are considered an Italian tax resident exclusively based on their physical presence. The foreign paperwork literally doesn't matter. So let's pivot to section 3. What if you actually want to transfer your residency to Italy on purpose? If you're officially making the move, here is your practical step-by-step roadmap. Step 1, you do the actual physical transfer of your home to Italy. Step 2, you get yourself officially registered with the Population Registry. Step 3, obviously, is physically staying in the country for more than 183 days in that tax period. Step 4, as we just talked about, involves shifting the center of your personal and family relationships to Italy to satisfy those new domicile rules. And finally, step 5, you really need to verify any applicable double taxation agreements between Italy and your home country to make sure the transition is smooth. All right, section 4. Let's talk about what happens when things get a little messy. The dual residency dilemma. This is the dreaded scenario, right? It's entirely possible that under domestic laws, two completely different countries might look at you and say, hey, you're a resident here, at the exact same time. Italy might claim you because you were physically there too long, but your home country still claims you based on your passport or where you own property. So how on earth do you solve that tug of war? Well, to resolve this clash, we have to look at international double taxation treaties. These treaties contain what are known as tiebreak rules, and it's basically like a waterfall. You have to apply them in this exact descending order of priority. First, they check where you have a permanent residence available to you. If you have a permanent home in both countries, it flows down to Rule 2, your center of vital interests. Where are your personal and economic ties closer? If that's still a tie, they look at your habitual stay. Where do you spend most of your time? Still tied? They look at your nationality. And if you somehow have dual nationality, it drops all the way to step 5, which is literally a mutual, negotiated agreement between the tax authorities of the two states. Finally, Section 5. Let's look at the actual, real-world consequences of Italian residency. Once you officially become an Italian tax resident, you are stepping into a pretty strict framework. You absolutely must submit an annual Italian tax return. You're required to declare all income produced in any country on Earth. And this is a big one, you are subject to strict tax monitoring. Specifically, you're going to get very familiar with Form RW, which is how you declare your foreign investments and financial assets. Now, it's not all doom and gloom. On the upside, you can usually benefit from foreign tax credits for taxes you've already paid in other countries, which helps mitigate the risk of getting double taxed on the exact same money. So, to wrap this explainer up, I want to leave you with this somewhat provocative question. Do your substantial, real-world roots actually match your paper trail? Because if there's one massive takeaway from the 2024 legislative decree, it's this. Italy is pivoting away from mere formalities. They want to see the substantial reality of your life. Whether it's shifting the definition of domicile to focus on where your kids are, or counting fractions of a day for your physical presence, or making official registration rebuttable, the authorities are looking right past the paperwork to see how you actually live. So if you are planning to spend a big chunk of your years soaking up the Italian sun, just make sure your day-to-day reality aligns with your tax strategy. Thanks so much for joining me for this explainer, and hey, make sure your travel plans aren't writing checks your tax return can't cash.